I've got to apologise. I was frantically running across Melbourne with a suitcase coming back from the SMSF Association, the Self-Managed Super Fund Association conference in Melbourne. It's like where all of the really good financial advisors and really good, technical experts around self-managed super funds coalesce, and then they talk about all of their products and strategies and thoughts. And it was a really good day. So shout out to the SMSF Association who threw that on, and I was lucky enough to go down. So welcome everyone to tonight's Selfwealth Live. Of course, I'm Owen Rask. I'm not in my usual surrounds today. I'm actually right beside the studio here at Rask Group headquarters because we're doing a live stream tomorrow. Well, it's technically not me. I'm just participating. I love it when I don't have to do much and I can just rock up and have a bit of fun and talk investing. But welcome to everyone. I can see Linda, Martin, Mike, Jenny, and Trey. I'm going to try and pronounce this. And you know how I am with names, especially like internet names. Trey B, 3P. I know you're regular, but I don't know how to pronounce it. Maybe you can do like one of those things like where it's like in Google where it says like pronounce it this way. But welcome everyone. Welcome to tonight's Selfwealth Live. As usual, I'll start with a bit of a joke. And here's my joke for this evening. A dad joke. This is my go-to resource when ChatGPT fails me. My wife said, "You really have no sense of direction, do you?" I said, "Where did that come from?" And that is my joke. Now, there was one comment from last week that said, we should really cut out the jokes. But I think the jokes are a highlight. I think this is like a 10 out of 10, frankly. Just a quick information warning, a general advice warning. So please take a moment to read this disclaimer. This is probably the second most fun part right after the joke. And in particular, I'll draw your attention to that Owen is the founder and director of the Rask Group, which is a corporate authorized rep, and there's a number there of Wattle Partners, AFSL 383169. Please refer to our financial services guide. That's what's otherwise known as an FSG in my language, and it tells you everything you need to know about Rask and what we do. So Rob's given me a 7 out of 10, which is, I would say, pretty good from Rob. To be honest, that's pretty generous, Rob. Thank you. Because, it did take me a bit of time to sift through those dad jokes to find one that was appropriate. And here we are. I've got some really interesting companies to cover tonight, and I'm glad we can just get straight into the meat of things. There was a question that popped up. There was a poll that was put up in the chat, by the way, if you haven't already answered it. At the top, it says, over 5 years, which company will perform best with dividends and growth? And I'll just bring it up here. I'll show you what my screen looks like. So you can see it. I think you can't really see it here. Let me see if there it is. There it is. There she is. I'll just zoom out a bit. So you can see your own comments. This is like a wall break, I think they call it. Like this is like Inception, where you're seeing yourself commenting and voting on the thing that you're commenting on, which is just, it's just spinning me out. But we can see here, over 5 years, which company will perform best for dividends and growth? We've got A2 Milk, Altium, BHP, or HUB24. HUB24's got a lowly 5% of votes. Rob says in the chat, my vote would be BHP too, only because that's all I know. That's all I know enough about. Well, we're going to fix that tonight, Rob. Stevie says, add CXO. That's core lithium. Stevie, I don't know if we can, to be honest, I don't know, mate. To be honest, I don't know, mate. Core lithium, I'm giving you the face. If you can see me off to the side, I don't know. If you think core lithium should be in the list, please let me know. But you can see on the list for tonight what I was hoping to cover: BHP, HUB24, A2 Milk, Altium, and I know you guys know this about me, but one of the things that I really like to do when I'm investing is I actually like to invest in small companies, like small cap companies. It's by far my favorite type of investing because I get to discover really niche businesses and new businesses. And so if you want me to talk about some smaller companies, I will do that, because a couple of my favorite smaller companies reported results, or at least, they're not my favorite. I don't really have favorites, but they're just really interesting small companies. I'll say that much. So if you want me to cover a couple of them, I can give you the kind of 101 of them. Pete said, has BHP said anything recently about Olympic Dam expansion? Not that I could see. I was having a quick glance through the numbers, Pete. There was a few things about record production and so on and so forth, but I don't know if I saw anything about expansion. We can have a look. Please add Peelborough, P-E-E-L. I think that's a suburb in just outside of Sydney. Isn't that right, Chef Circle? I'm pretty sure. Yeah, Peelborough. and it's listed on the ASX. But anyway, I'm getting sidetracked. So if I do answer any of your questions, just remember it's limited to general financial information only, and all the usual protocols apply, including that I don't know your personal circumstances, so you will need to see a financial planner for that. Interestingly enough, PLS growth, is that PLS growth, Mike? Are you saying Pilbara growth? BHP waiting for uranium price to go up. Now, I'm going to try and, I realized a few things when we've been covering results in recent weeks. I haven't really given you guys like the full circle context on how to look at a company and interpret things like analyst valuations and those types of things. Of course, I teach people how to do their own valuations, but I need more than an hour to do that. But what I wanted to do tonight was bring in more ideas and more strategies to do a lot of the work yourself. And so when you look at it, when you look at a commodities company, you can use this website. It's called indexmundi.com. And here it will show you the prices of commodities over time. And so this is particularly relevant because we're going to be talking about BHP in just a moment. But this website, it's typically like a month delayed. So it's typically like monthly coal prices, monthly iron ore prices, so on and so forth. But you can use this to study a company like the latest commodity prices. There are other websites like Trading Economics and so on and so forth. But I find this is pretty good. So that there's a bunch of mining websites here in Australia as well that kind of give you some commodity price indexes as well. But Index Money tends to have them all. And I always look at this when I need to interpret results from the likes of Fortescue or Whitehaven or BHP or Rio Tinto and so forth. And this is basically how I kind of look at things. Monica, you've said, I'm also interested in Nick Scali as it was the first share I ever bought. I think you've mentioned that before, Monica, that you bought Nick Scali. And Mike, you said Pilbara growth. It got to 1 million tons. Is that right, Mike? Hello, Paul. Good evening. Damn computer made me log in again. Don't you hate that? I've got about 5 YouTube profiles, and every time I try and log into one, it just throws me a different direction. But anyway, so anytime I'm going to look at any commodity producing company, I always check this website to see what's going on with prices of key commodities, so I can actually interpret the results and have them kind of like have context around them. So, for example, over 5 years, we can look at, say, iron ore prices. So if I looked at this and I was like, well, iron ore prices have fallen recently, well, you're probably going to expect a pretty soft result from BHP. And that's basically it. So you just look at these things and you just look straight at commodity prices, because I think I showed you guys this around about mid-year last year when we talked about Fortescue in one of the Selfwealth lives. We talked about how basically inside a commodity producing business, when we do our modeling, so we always try and, when we model companies for valuation, we always try and get to like, what are the sales going to be next year or the revenue? And the easiest way to do that is just to take the commodity price. So iron ore is selling for $150 a ton, for example. And how many tons were there? Well, there were 100. So then you'd multiply those two numbers together and you'd get your revenue target for next year. But obviously, when you have a commodities business, they don't set the price for their iron ore or for their coal or whatever. They're set by the market. So the commodity price can do this a lot of the time. And your skill as an investor, and in particular as a long-term investor, the key skill here is to look at companies and kind of see through those results. So look through the results and say, well, structurally, where is the commodity going? And that, if we look at this chart here, you can see that, you might say, well, in 2021, commodity prices were clearly well above statistical average. So there was an imbalance in supply and demand. And you could say that more recently with coal. We can see that coal's had a bit of volatility, you could say, recently. So you can see that, thermal coal prices have come back. Oh, sorry, that's iron ore. I'll keep going back. Here we go. So you can see here with coal prices, you can see they've come back recently, but they're still well above long-term averages. And this is because, we've all heard the news, like Ukraine, Russia, like COVID, supply chain disruption, and a continual march of this burgeoning middle class in Asia and India. And so we can see this here. So in any case, I always check these before I look at the company's results. So when we look at something like BHP, we can see that reflected in the company's profitability over time. So here we can see there was this low patch where results were pretty soft. And this just measures, by the way, guys, this just measures, it's simply the return on capital. So the the amount of money that BHP's investing in itself is generating. So if it takes $1 billion and invests that in a project, what's the return? Not just of that project, but of the entire BHP business where they're investing money. And so this just maps it over time. And you've heard me say before that anything that's like good double digits, so 20% consistently, is actually very, very good, especially at the scale that BHP is at. And the reason it's been able to do this over such a long period of time is because its costs are lower. So even if you get that up and down in commodity prices, their results are still very strong. And so you can see that there was a lull here in results. And this is when commodity prices took a bit of a bath. BHP itself also did some capital management where it cut its dividend, decided to spin off some businesses, and we can see that the return on capital is bouncing back up again. And we can see that also reflected in dividends, right? BHP in the latest result just out yesterday, BHP, what was it yesterday, the day before? BHP came out and cut its dividend versus the corresponding period last year. It was about 70% of profit was paid out as a dividend, but you can see it was a steep cut in the dividend. And that's simply because of the commodity prices, right? So that is why you always start with the commodity prices to get context, because you don't know. Like you do know in advance with BHP and Rio, they do quarterly activities report. So a quarterly activities report is where they tell you how much they've produced, like how much they've dug out of the ground, how much they've sold, but they don't tell you the revenue. They don't tell you how much they sold it for, et cetera, et cetera. So you get that ahead of time. But the thing that we don't know is the commodity prices until the results drop like we have here. And so if we go into BHP's result, they often talk about this thing called realized prices. Realized prices being the actual selling price during the quarter or year. Because sometimes they can lock in a certain amount of commodities forward. So they can say, for the next 6 months, we're going to supply commodities at this price. And there might be a buyer for that. But sometimes there are changes to that. And that's why you have realized prices. So you can have realized prices here decreased. And that's basically the driver of the business. So Paul, you said, I've been in and out, unfortunately. Is this about BHP selling of the coal assets? So Paul, selling off the coal assets. Yeah, right. So basically, this is what I'm talking about here is just more generally speaking at a high level, how I look at something like BHP and use a website just like this to get a sense of what's the context, what can we expect? And then you can take that. And for example, I was reading a Motley Fool article, which I seem to have got rid of. I don't know why it's not up here. I was reading a Motley Fool. KK Katie, welcome, first time here. Welcome to the show. Paul, there was a Motley Fool article which basically looked at like Goldman Sachs numbers and said that, there was a slightly weaker result than Goldman Sachs had expected and blah, blah, blah. But you got to remember when there are very minor differences between the selling price, if we come back into Selfwealth here, when there are very minor differences in that, so not the selling price, yeah, very minor differences in the selling price, that could be up to like, December 29 and December 30th and all that sort of stuff. That can actually mean that a company like BHP misses analyst targets by 1 or 2%, right? And in the grand scheme of things, that's nothing. And yet that can be the reason that a share price of a company sells off. So the moral of the story here is having that context before you get the results is actually really critical. And I just say, like, see here, that this is basically like the result release and you've got a sell-off, right? Which is just unjustified. And that's why it bounces back. And so just before you look at a mining company, just please check the commodity prices before the result, because it'll give you a pretty strong indication of what it's actually going to achieve. So just generally speaking, like the BHP business, super strong. Commodity prices like copper and iron ore. And in terms of coal, the rhetoric was that, there were interruptions basically, Paul. So overall, BHP's result was very strong. The dividend is the thing that will probably keep a lot of investors wanting. So we can see here, the interim dividend was 90 cents, whereas the previous period was 150 cents. And so you can check that inside Selfwealth, of course. You can go in and we can go financials, and we can see if we go to, where am I? Oh, further down. That's why I'm not in the right spot. Keep going down, down to down. And we go dividends, and we can see over time the dividends per share. And we can see why that would be such a big issue, because if they're cutting the dividend now, I think that's the big concern for a lot of income-focused investors. But I do have another chart on this, which I'm going to show you in just a sec once I can expand my screen a bit so we can get a bit more context. Is that better? Yes, that's better. I go down a bit. Okay, so here we can see, like, in terms of analyst forecasts, I wanted to draw this. So one thing that we've focused on in recent weeks, and if we go back into my slides, one thing we focused on in recent weeks is basically I've showed you like how to look at a company's result and see if it's, give it a score, see if it's good, and basically how it stacks up next to other companies. And you might have to even go back further again, where we talked about other companies, and I think there were small caps right back here. But basically, in terms of how do you kind of put a ribbon on BHP's like valuation, and how do you think about that through time? And the bigger a company is, the more stable the profitability and the metrics of a company will be. So in the case of BHP, you can see the dividend yield here over time, which is tracked over time. This basically shows you the trailing dividend yield and the share price in one chart, because it's showing you that there was a dividend paid each and every year, because otherwise it would be below zero. And through time, the share price has been extremely volatile, but also the dividends bounced up and down. Now, one way you can look at a company that's quite mature is or even an early stage company, is you can use ratios, or what we call multiples. So you can do, say, the price to sales, which is just simply the share price compared to the sales of that company. So price per share divided by sales per share. And it gives you this relationship through time. And so what we can see here with Altium is we can see that the valuation has stretched. So the same amount of sales for the company, each year that has gone past since 2011, investors have been willing to pay more and more and more and more until we got to around probably this period, and then it started to come back down a bit. So investors were paying more for every dollar of sales. But what you really want to see when you see the sales go up, so as an investor, as a long-term investor, the reason why Altium is one of the top 10 best performing companies in Australia is because the sales have risen while the profitability has also crept up. So I'm going to get to the company results in a second, but we can see here that they were reporting, like, this is the profitability. This just means earnings or profit before interest and taxes are paid. And the reason we use this is because it excludes the interest on debt and the interest received from cash and the taxes that are paid to the ATO or to whoever. And so it gives us a more true picture of the profitability of the actual business before taxes and all that sort of stuff. So we use EBIT for that, just earnings before interest and tax. And so we can see here, this is comparing the EBIT profit, the profit margin at the EBIT level. And what it shows you is that for many years, Altium was negative, or like it was very volatile. But then as sales have risen, so too, and it's kind of reflected here, so too, we can see the profitability increasing. So not only are we getting more sales, we're getting more profits. And that's what we call operating leverage in action. And we can also see that playing out in another company, the other company, which we talked to a bit tonight, which is HUB. And HUB, I'll explain, because it's a business that we haven't really talked about. And yeah, that's right, Mike. So fantastic growth from Altium. And we'll come to that in just a minute. But with HUB, it is also what I would say is like the quintessential, or like the perfect example of a growth company. Because what you want is you want the revenue increasing, but you also want those profit margins. And by the way, another way to say EBIT margin, like this, is to say operating margin, because it's the business operations. And you can see that here. This is operating margins of HUB. And HUB is a company that it does software for financial advisors and investors and people like SMSFs. So I'll come to that in a minute. But basically what it does is you plug in and you can kind of see it play out over time. And here we can see that the revenue in the blue, this light shade of blue, is increasing, while also at the same time the profit margins started to increase rapidly. So at the very first year in 2015, here we can see it was negative, so they're making a loss. And then it crept positive. So on this right-hand side here is the chart. It crept positive over time. And even small changes in the profit margins can have a profound impact, and the share price can react accordingly. So coming off a low base, I'll bring this up here. So is Scruffy, is the price to sales historical charts available out of Selfwealth, or did you export them from another tool? Yeah, I exported them, Scruffy, so I exported them from Ticker Terminal, TIKR. I've used it on the show before, but Ticker just shows you it through time. I wouldn't be surprised if the Selfwealth team do add this functionality in time, but I'm not 100% sure what they're up to. But they may add that in time, because I think it's something that a lot of investors do like to see. But in any case, we can see, if we go back to stock details here, we can see over time, we can see the performance of HUB. right? So performance-wise, HUB's gone from about $1 a share in that period that I was talking to before, up to around $26 per share. So this is the quintessential example. This is the exact example of what we're looking for when we're investing in the satellite part of our portfolio. So remember how we've talked about this a lot. Just for people like Katie that might be new, you've got your core portfolio, which in my opinion should be made up of ETFs. It's kind of like a no-brainer. ETFs and maybe a few funds and things, or blue chip shares, just very stable long-term positions. And then around the outside, you would have individual shares or high growth businesses. Now, I favor personally, if I'm hunting for yield, if I'm hunting for income or passive income, I don't use individual stocks as a kind of general rule. I would use them from time to time, like BHP has a great dividend yield. You saw that. But if I'm investing my satellite, what I really want is growth. And obviously that growth will eventually come with dividends if the company starts paying dividends. So in my opinion, HUB is that kind of business that is perfect for considering for the satellite. Now you might remember, so let's start to jump into the results. A few weeks ago, you might remember when we went through, maybe it was only last week. Was it only last week? We went through net wealth. So net wealth, I said to you guys, we could use as a good proxy for what HUB might report. So net wealth came out and they had revenue growth of 19%. They had a profit margin of 30%. There weren't any cash flow anomalies. They had a good cash balance, like positive cash balance. So that would be another way to express that would be like that. But it's positive 84 million, meaning there's more cash than debt. It had a positive outlook, right? And probably the thing that held it back was there was a slight kind of like, it looked like it slightly, in terms of advisor numbers, maybe wasn't expecting as much growth from the number of financial advisors using its software. And whereas HUB's come out, and HUB's results have been very, very strong. And we can see that here. If I come up the top here. So HUB is basically the same as net wealth. And one of the things that I highlighted last time was that like a rising tide lifts all boats. Maybe not always. It's probably like a limitation. Maybe this rising tide lifts all boats, asterisks. HUB, fantastic growth. Yeah, that's right, Mike. So the thing to keep in mind when you're investing in these types of growth businesses, and I wanted to bring this slide back up again of HUB. One of the things you got to keep in mind when you look for these types of businesses, when you're hunting for these in the wild, it's important to remember that sometimes the majority of this growth that you see in, say, sales or revenue here, the majority of this growth actually comes from the industry growing. So just being in that industry, you see growth. And I'll give you an example. At the Rask Group, right? Like at Rask, our podcast audience has grown 60% year over year, right? It's just kept on growing. 60% is what we're currently growing at. And I would love to say, that's because we're geniuses, right? We're doing so much fantastic stuff and we're just growing so fast. And maybe we are doing some good things, but a lot of that is just more people entering the podcast ecosystem. So more people taking on podcasts, right? And so you get this kind of like groundswell where everyone lifts up. And for HUB, we see that too, but we also see it with net wealth, which is why it has been able to grow fast, right? In an industry that is also growing fast. I kind of liken it to like, when you're surfing, if you've ever been surfing or bodyboarding or something like this in the swell, and you have a wave, right? And you're just riding that wave, but then that other wave goes over the top of it. And then you kind of get like a push along extra fast. And it's kind of like that. It's like a wave riding a wave and you're riding that. And so this is what tends to happen with companies like HUB. But the key distinction is this. For businesses like HUB and for net wealth, what makes them particularly special is that as they grew, they also grew more valuable. Some companies, when they grow, they don't grow valuably. They just grow sales, but they don't actually become more profitable and they don't keep a lot of their customers. Like oftentimes, like say like Afterpay is probably an example of this. 2 years ago, everyone was using Afterpay. The thing was exploding. It was a really great investment. The stock went through the roof and it eventually got taken over. But now I would guess that it's not growing nearly as fast and its profits are huge. Its losses are huge because of everything that's happening in the economy. And so net wealth and HUB and the other business, which is Premium, which to a lesser extent, these businesses have been able to grow a product in an industry that is growing for them and they've been able to lock customers in valuably, because once you're on the platform, once a financial advisor is using HUB or NetWealth, they don't tend to move off. Sorry, I'll just have a quick sip of my coffee. It's been a long day, so I'm drinking coffee at 6:29 p.m. Melbourne time, which is it's blasphemy, I know. My sleep doctor would be saying, please, Owen, don't do that. But I did it anyway. So HUB, really good, really, really strong results. But I want to highlight something in the results that maybe if you don't know the business and you're not that familiar with, it actually acquired a business called Class. So HUB acquired Class, right? So just to give you a concrete example of what these two businesses do and how they fit in. So imagine you want to invest with me and you come to the Rask Group and you say, hey, Owen, I want to invest and I want you to do it for me, but I'm also happy to kind of play along. So a business like HUB, they provide the software for an advisor like me. And I would come along like as an investment advisor. I mean, not necessarily as a financial advisor, but as an investment advisor. You come to me and I would say, yes, you can, here's how you can get involved and you can join us on the HUB platform. So you go to HUB and you sign up, or we could do it for you if we were financial advisors. And we manage your money, but you pay a fee to us and then we pay a fee to HUB. And that's basically how it works. Cup and handle, that is a buy signal. I see you, Mike. I know what you did just there. I see what you did. So when you have a business like HUB, it focuses on financial advisors. They recently bought out Class, which was another ASX listed company. And this is very similar, but slightly different. Class is the Australian leader, if I'm not mistaken. Class is the Australian leader in that type of software, but for self-managed super funds. So you have HUB, which is specializing in just general financial advice and investment, but then you've got Class, which does it all for self-managed super funds. And so you brought them two together, and that's why you have these pretty strong growth, because self-managed super funds are also growing. But that's the big kick up in revenue here. So don't be mistaken and thinking that it's all organic growth. Some of that was acquired growth. Some things that, before we move on from HUB, some things that you would want to look at is you just want to look at the profitability of the business over time. So you can see like the expenses, you can see the revenue, but you can also see the expenses here. So you can see like there's obviously a footnote 2.3 that we could go down and have a look at, but you just want to have a look at the key expenses. You want to make sure it's growing profitably. My expectation is with HUB and with NetWealth is that over time, the margins get more competitive. And even though they're in this rapid growth phase at the moment, there will come a time where they're competitive on price. And at that point, we've got to really see, are these businesses as strong as they think they are? And I think the answer is yes, but that's kind of the key insights. As their growth sort of slows off, as less financial advisors are available to onboard, because if you don't know, Australia has a huge problem with financial advice. It's inaccessible. And so there are fewer financial advisors, and that means there are fewer customers for these platforms. So for NetWealth and for HUB. So as we see those kind of like, as we see the growth moderate, not fall away, but moderate, how do the businesses react? And finally, I wanted to turn it around and talk about the valuation. So inside Selfwealth, you can go to forecast and you know that you can come down the bottom here and you can look at price targets, right? But then further down the page, you can also see revenue targets. And you can say, well, okay, analysts estimate next year it's going to make 271 million of revenue. And you can say the same for 2024, it's going to be 316. So that's the analyst target, right? They've just made that up. Who knows how they got to that? But if you go back to our slides, and this is the key insight, all right? Let's use Altium. Even though we're not comparing apples to apples, we're comparing HUB to Altium. But let's say, for example, that HUB's profitability, revenue could grow to 300 million, right, in 2 years. You could look at a chart like this and just using a simple valuation multiple, like price to sales, you could say, and just imagine this is HUB's numbers and not Altium's. You could say, well, it looks like in the modern era, the average price to sales ratio is around about 15 times, right? 15 times. So at 15 times, it would look something like this. You would say, so this is, remove this, and I'm just going to do this. It's going to be crude and it's going to rub some people the wrong way. But basically what we'd be saying is $300 million of revenue, times 15. So 300, I'm just doing this in the computer, 300 times 15 is 4.5 billion. So where am I? Yeah, equals, I should have been able to do that off the top of my head. So 4.5 billion, right? And that's our valuation. Now, everyone can throw tomatoes at me. I'm not trying to say that this is how you value every business, and there are limitations of this. But it is actually a very simple heuristic, and it gives you a sense of how to think about how valuations are created. And so if we go back into our kind of, I guess, database of information, here's the key thing. It's like, how do we take that information and then compare it and make sense of it? Now, what I might actually do is I might actually do this example. I might complete this example for Altium. So in the year ahead, because otherwise we're going to mix apples with bananas here. But so in the year ahead, instead of 300 million, we might take Altium's numbers. And I'm just going to wait for this to load. And while it's happening, I might take another sip of this coffee here. And so if we go to forecast yet again, and we scroll down, and we've got for the 2 years, actually it turns out it's also around about 300 million. So we'll go with that for Altium, 300 million. And now we'll go, and we know it's about 15 times, meaning the price to sales ratio should be average around 15 times, right? Now we can say, okay, we've got our 4.5 billion. What do we compare that to? Well, we compare it to this number right here. Zoom right in on that. We compare it to here. So what we're effectively saying, this is to tie the loop, and this is just so everyone going forward can understand how this comes together. Here we can see that we're saying in 2 years' time, we expect revenue to be $300 million a year. If every investor in the market is willing to pay us 15 times the sales, or a price to sales ratio, which you can see here, of 15, that equals a valuation of the whole company of 4.5 billion. Now we know that the current valuation is above that. So that would be above the valuation, meaning it's overvalued if we expect the other two things to be true. One, that we think revenue will hit 300 million, and two, that we think the price to sales ratio is going to hit 15 times, or it's going to stay around 15 times. Now you might be thinking this is crude, and it is, but this is actually how valuations are done in private markets. So that's how it's done. So Pete, you've said, but the range of price to sales was 10 to 20, gives a valuation range of 3 to 6 billion. Yes, it does. So this is the key insight, Pete, is that there are substantial limitations to this metric, but people were using it over the past 5 years to do all types of their valuation work. But I'm actually going to show you another way that people go wrong with this, Pete. Now, there's an extra piece of complication here with a business like Altium. So here we can see the currency is in US dollars, right? So this market capitalization is in US dollars. Now, if we come out here and we look at Altium and Google Finance, this could be US dollars, at least it should be US dollars, but here it says AUD. So which one are we to believe? Is it AUD or USD that we're looking at, right? Because Altium reports its results in USD. So if USD is what we're looking at, we have to make sure we're comparing apples to apples, right? And so this is a key thing where people go wrong. Even in valuation theory like this, a very simple valuation idea, they get currencies mixed up. They get financial years mixed up. And so I don't have it on hand, but one of the other things that happens, Pete, is that when we do discounted cash flow analysis, which is considered the gold standard for valuation, right? We just really had 3 metrics in this valuation. We had the sales, the multiple at which we would be selling the company for in the future, which was 15 times. And we basically just knew the market cap today. We just had 3 variables, right? So we knew what the company was worth today and what we expected it to be worth in the future, given the sales and given the multiple. Well, in a discounted cash flow analysis, we could have hundreds of different lines or cells or items. And that's where things get even more wild, Pete. And that's where things like, I think it pays to just be as simple as possible. But if you remember back, the reason why I wanted to go through this example with you is that one of the favorite guests on the show from 2022 was Andrew Page. And Andrew Page used this exact tool to do his valuation of Alcidion, or the ticker symbol ALC. And this is and Andrew's I think Andrew's one of the best investors in the country, personally. And this is what he would use for certain types of companies. He would use a slightly more, just an ever so slightly more complicated thing. And he would actually do his own, forecast for revenue and what have you. But that's how you can tie all of the things that I've discussed in recent weeks, things like the quality of a business, how it actually, like what's it actually worth. You can actually fill out this final section. Where is it? Right here. You can fill out this final section for yourself. And there was actually a comment from this one. I'll bring it up so you guys have got it. There's on the Rubenstein show, Warren Buffett, Rubenstein show. The Rubenstein show is a fantastic 30-minute to 40-minute interview series with David Rubenstein. So I'll drop this in here. This is a video that goes through Warren Buffett's story, and he talks to this. He's interviewed, and in one of those sections, he said that he made an investment of tens of billions of dollars within 36 hours, and because he knows that investing is really not that complicated once you build that understanding of what a business can achieve and how it can go about it. Inflation side effect, going grunge with the alley wall background. Yeah, that's it. So inflation is really biting here. So I had to take some paint off the wall and sell that plant one. It's good to see you, by the way. So that's why it's, Melbourne, it's one of these places where they think it's trendy, but it's all just cost savings. But anyway, so let's just kind of tie some ribbons on these things. The first is that the BHP result it wasn't what analysts were expecting, but I think it was pretty good. The dividend was weak. HUB's results were fantastic, but they were driven in part by class. So let's talk about Altium. Altium's results were, in my opinion, quite strong, to be honest. They were quite strong. The fact that the company reaffirmed its guidance was pretty good. They came out late last year in August. Maybe it was a little bit later. I think it was August, actually. So mid to late last year. And they put out the really strong guidance. And they said, we expect revenue is going to hit this level and profitability is going to hit this level. And I'll get to why that happened in a second. But for those of you that don't know, I should start with what Altium does. I've talked about it a lot. It creates the software that is used by engineers and electronics designers to create the little circuit boards that go inside smart devices. So like watches, phones, computers, so on and so forth. And anyway, so the company sells its software on subscription. And so it has pretty good visibility of what's going to happen in the future, knowing that it's got these customers kind of tied into the ecosystem. This is why I love software companies. Because they get really good visibility on their profitability, they get really good visibility on the number of customers, and they'll publish that for you. And so here we can see EBITDA margin was up 36.2%, up from 34%. So this is that kind of profitability increasing, even as revenue increases 17%. So recurring revenue, which is that subscription revenue, is now 79% because they're on a multi-year transition. And you can see that's really positive in my opinion. To increase the number of subscribers, as a proportion of your revenue over 1 year is really impressive, especially at this scale. Dividend, also very strong. AUD, remember they report in USD. So when they convert the dividend back to Aussie currency, it can be affected by the currency conversion, good or bad. In particular, there were some things I'll call out here. And the one I'm going to start with is this one, Octopart. Octopart is, and I've showed you this before, but for those that are new and what this company does, it's basically the Google for all of those little bits and pieces that go inside your electronics device. So for example, if you have some type of integrated circuit, or here we go, we can keep digging down. Let's go to Texas Instruments tool. So here we can see, say this little thing that, if you pull apart a phone, or even here's a TV remote. If you take this TV remote and you pulled it apart, why don't we just do this live on here? You would see that inside this, I'll see if I've got one, and I'll break the TV that's in the office. So, oh, no, I can't see it. But if you pulled apart this, you would see that the inside there's like a green or typically blue little electronics board. And in there, you would see a bunch of these resistors and transistors and so on and so forth. And so you can buy these by using Altium's search engine, just think of it like Google, and you can then put them straight into your design. But another thing that Altium does is it also sells ads. You know, if you come in and search for something like, I don't know, analog to DC, like analog to digital converter, right? If you put this in here, there could be an ad. And Altium, the reason why this is important is because I'll explain how it comes together. But average revenue per click increased to $1.99, up from $1.55. So here we can see that people are paying more in the ecosystem when they're searching for little bits and pieces to put on their chips and whatever. And for me, this is the number one thing that I look at for Altium, because it tells you how many people are using its software to find components that are used also in its other software, where it does the designs and all that sort of stuff. So in this instance, what you have is you have like what we call a leading indicator. So it basically tells you what's going to happen. And so 6 months ago in August, we saw the most demand and the most usage of Octopart that we'd seen, I think, ever. And what that said to you is basically, well, in the future, people are probably going to be using the software more because they're buying stuff now. So they're buying the components now, which means they need to design it, they need to find the stuff, and they're going to keep using it. And so that was a really good indicator. And we can see that now playing out in like the number of subscribers and the revenue per user. So this is all like indicating that the software is becoming more and more valuable. So even though the share price, I think the share price of Altium fell, I think. Where is the share price? I think it might have actually even fell. Could be wrong. Yeah, it fell this week. So making robots to get rid of jobs. Yeah, they're all making, yeah, Mike, let's not go down that path. But yeah, so you can see here the share price has fallen when in fact it's probably a good result. Right, it's probably a good result for the company. So if we go, and I might just zoom out a bit here. If we go to financials, and we look at revenue through time. Actually, we'll go revenue through time. I mean, that's pretty impressive, right? Like it doesn't really come better than that when we're looking at companies. But if we go to forecasts, and we'll just use revenue. And we can see here, even in the next 2 years, revenue is still guiding higher. And the point is that this is another company that's being lifted, like that rising tide lift all boats. Well, Altium is in that rising tide where more engineers and more designers are using electronics design software to create smart devices, like Mike was just saying, maybe even things that use AI. You know, there are more remotes today, I imagine, than there were a few years ago. There are more computers, there are more phones, there are more smart fridges. And so Altium is playing in that market, which is also growing, but it is also taking more share of the market, which is growing. So it's getting bigger as it grows, like as in it's getting a bigger slice as the industry grows. And so these are all kind of like leading to, I guess, a better outcome for shareholders. And from one period to the next, for the most part, it's going to be volatile. The business is extremely volatile. There are a lot of weaknesses in the business. Like it's a competitive industry, but also the company, I would say, is incredibly promotional. Like some of the language that they use is unbelievable. If it's such a good company, you shouldn't need to talk about it like that. Like preparing for a transformational impact. Like why not just say like we're going through a transformation or something like that? Like that I think throws a lot of people off. People are like, well, this sounds pretty spooky. Sounds like someone's trying to sell us something, even though we're just looking at company results. So I think that's one thing. Another thing, actually, just while I've stopped on this page that I always look at is the number of subscribers. And normally they throw us a chart which compares free users versus paid users versus, here we go. This is the one. So here we can see the number of active licenses. So they have different types of software, the number of licenses that are active, that are actually on a subscription, and you can see the number there, that are exploring the use of cloud. So maybe they have it enabled or they're using it. I'm not sure what that means. And then we've got full cloud adoption down the bottom. So the number that are actually using all of it in the cloud. And they have this kind of really aspirational target that they really want to meet as a business in the future. And I don't know if they've got that at the top. But basically, the business, they say, is on track to do that. And for the most part, if you think about how to analyze a business, you want to know how many customers you have and how much that you're charging them. And that's basically how you work out what Altium is worth as a business. So how many customers do they have and how much do they charge per customer? And they're trying to increase both of those by being relevant in the industry to increase subscribers. And then the other thing that they're trying to do is they're trying to create better products. Like, instead of having one engineer in a team of 10 that has a subscription, well, why don't you just use why doesn't the whole team get a subscription, and we'll do it for only 20% more, knowing that in the future, once they're already designing inside Altium, well, then everyone won't be able to give it up, and then they'll be able to increase prices. So yeah, that's that one. So Pete, you asked a question: is this an example of currency confusion? Earnings per share of 22.5 cents per share, but dividends of 25 cents per share. AUD versus USD. Absolutely. So this is a really important thing, Pete. Remember how I said before, where you compare the valuation of a company. So when you look at a share price inside of Selfwealth, or if you're in Google, you're looking at the Australian dollar share price, right? But the financials of Altium are in US dollars. So what we tend to do as analysts is we'll do a valuation of the company, everything in the spreadsheet as the company presents it. So you would do your valuation in US dollars, you would do your numbers and all that stuff, and then right at the very end, you'd convert it from US dollars to Australian dollars. And that's how you do your valuation, right? A lot of people forget that last step, or they try and do it somewhere else in their valuation, and they just get completely wrong. Like, it is just so wrong. And then they get things like that where you can see, like, you would look at a company and be like, wait a second, how can it have more dividends than it does in profit? That doesn't make any sense. And so that can happen a lot. Ben, you've said, how can a retail investor research a company's management team when valuing a company? That's a great question, Ben. Multiple ways. So, I mean, there are so many ways. So one, tune into we've been through this quite a bit on the show, but one, tune into their webinar. Like, most of the companies, if we go back into it, so most of the companies, when they put out a media release, none of these are actually, is this a media release? Yeah, they'll have like this conference thing here. Just chuck in your information and you can jump on the call and hear from management. Are they candid? Are they not candid? Are they kind of forthright? Do they answer questions? So basically, the way it works, if you're new to this, Ben, the first half an hour to 40 minutes of an investor call is just management talking to the PowerPoint that they created. But then the second part is the most valuable part, and that's where analysts ask their questions. And just so you know, Ben, a lot of people don't know this, but when you ask a question, so you might be able to ask a question if it's a small company, but if it's a large company, typically only analysts can ask the questions. But what tends to happen is, if the company knows that a hard question is coming, they'll dodge that question in the queue. But these things happen, right? Management don't want to answer them if they don't have to. So they'll just try and dodge them. So you're looking for a management team that is candid. And if you want a really good insight into a company, Ben, that I think the management team are candid, even though it hasn't performed well recently, is I'd encourage you to go and look at Okta's quarterly results, quarterly earnings. So Okta is a business that sells cybersecurity. We've talked about it. It was in one of our hypothetical portfolios, but you can just come in here and listen to the webcast, right? And I would really encourage you to pay attention to how the management team respond to questions and how they describe the business. Because I personally think that there's a huge thing to be said for actually just studying the people. And the problem that happens with that, Ben, is a lot of people think that that's really wishy-washy. Like, oh, but a company is designed to make profits. How can you just go off what the guy's saying? Well, you can kind of get a sense. And I've followed Okta for years and years, and Altium and BHP and all these companies for many years. Basically, like BHP since my career started in 2012, 2013. And over time, you get a sense for these people. Do they do what they said? So in the next one, Pete, you said Santos today was a marvelous example of evasion. Yeah, well, I've I reckon I don't know how many I've tuned in for, Pete, but I can tell you that like there have been some shockers over the years. And so what you're looking for is candid responses. I actually caught up with, I was very blessed this week. So just as a quick aside, and while I pay gratitude for myself, so I'm here in Melbourne, but I was in a podcast on Monday morning, and I got a message come through and said, "Hey Owen, do you want to interview a guy by the name of Lawrence Cunningham?" And I was like, "Lawrence Cunningham, of course." So if you don't know who Lawrence Cunningham is, Lawrence Cunningham books. So Lawrence Cunningham is the author of these books, all of these great books. I would say he's one of the top financial authors in the world. And he just happened to be passing through Sydney. And I got a call from the Australian Shareholders Association saying, "Hey, Owen, Lawrence is in Sydney. There may be an opportunity to interview him." So I literally went straight from the office here, grabbed my microphone and went straight to Sydney. And I got an opportunity to speak to him. And one of the things that he was talking about when I interviewed him, Ben, was that when a management team treat their shareholders as if they are owners and operators of the business, it tends to be the case that there are better results. So what I mean by that, Ben, is imagine that you go and invest in a company and that company speaks, acts, and conducts itself like it was your business and you rightfully own it, which you do, by the way. That is a sign of a management team that cares, right? And not all of them, like some of them are great speakers and very charismatic, and their insides are kind of dodgy. But I think that's like a way to think about that. And so you can go and listen, Ben, to listen to any interview that Lawrence Cunningham has done. The interview that I did with him will air at the Australian Shareholders Association meeting in Sydney in a couple of months. So if you are in Sydney or you want to go to Sydney and hear from some brilliant investors and myself, I will not put myself in that category, but some larrikins as well, come up to Sydney and I'll meet you in person. But I mean, there are so many great books on the topic too as well, Ben. As Pete alluded to, there's kind of some dodgy operators getting around as well. So you just got to, and then another great example is a company called Mercado Libre in the US. So another good company that thinks about that. Finally, I mean, there's Amazon and there's Warren Buffett's letters and a company in the in Canada called Constellation Software. There's so many ways, and I could talk, ad nauseum about this. So I'll pull myself up here. Okay, so finally, let's just have a quick talk about A2 Milk. So I haven't actually had a chance to jump right into the results. So let's get it up. Does anyone own A2 Milk here? Not the actual milk. I've got plenty of milk in my fridge at home, but the shares. Do you own the shares? Thanks, Owen. You give me a few things to research. Well, I hope so. Pima, when is it? If you Google ASA and you Google, so ASA, and you Google Sydney conference, it'll come up, Pima. I think there's an offer coming out. It's quite an expensive event because it's quite a good event. Like, it's very good. It's the number one. I think it's $470. I think, I don't know for sure. Anyway, what was I doing? Sidetracked. A2 Milk, you own A2 Milk. Oh, yes, you have said this before, Jenny, you do not own A2 Milk. So A2 Milk went through this period where it was the darling child. Bloomberg, the best financial news organization in the world, named this company the best performing company in the world. I think it was over 10 or 15 years. That was the kiss of death for A2 Milk because that was right around here. And then you can see it's just come tumbling back down to earth. Timothy, you own A2 Milk. So I won't be able to, unfortunately, just with time constraints, I won't be able to do it complete justice here today. But basically, the story of A2 Milk goes that it expanded into China. Everything was fantastic. And then it got to here. And then there was basically COVID is one of those things. But one other thing was like Australia v. China trade war, if you remember that. They were putting tariffs on this and that. We were saying they were involved in COVID and blah, 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 blah. The thing went on and on and on. And companies like A2 Milk, Blackmores, all of these really high quality companies got absolutely smoked. And there was once upon a time, and I think I've shown this on the show before, and I do not know exactly where I've got it. I'm going to try and find this. A2 Milk chart, China. So I once released a flow chart of how everything works for A2 Milk in China, and it's not coming up now. But basically, where A2 Milk's business sat in China, I'll bring my screen back up. A2 Milk's business sat in the middle here, right? And then around the outside were all of these semi-government owned organizations that basically had either an ownership stake in A2 Milk or were in control of manufacturing or licensing and so on and so forth. And basically you had A2 Milk in the center of this big flow chart, and you could see it was plain as day that A2 Milk had no control, zero control over what it was doing in China. So that left A2 Milk in this very precarious position where it was basically at the mercy of these trade relations, but also of these really powerful partners that were in China. So the Chinese, one of the Chinese counterparties issued the license for A2 Milk to operate in China. Another one owned A2 Milk's manufacturer. Another one was in charge of like inspecting the quality of the product, even here in Australia. So like another one was like the distributor of the product in China. So basically A2 Milk's entire, outlook was dependent on these counterparties. And I personally, as an investor in a long-term business, the one thing I don't want is I don't want to see the company, its future dependent on another company or another party. Of course, you could say that about anything. You could say like, well, Heinz baked beans, right? There could be like baked bean regulation that comes in and just squashes all the baked beans and no one's allowed to sell baked beans anymore. But that's very unlikely. So when I look for businesses, I try and find businesses that are really kind of like so rock solid that risk is taken care of. Now, you are compensated for that nowadays because nowadays the share price has fallen, right? So the A2 Milk share price is down a long way, and I can see Mike's has said 23% growth. So now that the share price has fallen, maybe you're more compensated for that risk. So we go back into, and by the way, A2 Milk has responded to this, and I tried to find a quote for this in the lead up to tonight. But there was this fantastic podcast, Tim Ferriss, Morgan Housel. So if you're a fan of Tim Ferriss, the podcast, this is a 3-hour podcast, and I've listened to it twice. So I am going to get this link for you. This is the podcast down here. I'm going to get this link for you, and I'm going to drop it in the chat there. So this podcast, in this podcast, Morgan says, never underestimate. I'm going to paraphrase because I couldn't find the exact quote because I didn't have time to like go through the 3 hours and find where the quote was. But in this podcast, him and Tim basically allude to this idea that you should never underestimate the ability of a company or people to adapt. And you see that a lot of the time when you look at companies, you see their results and they look like they're coming down, profits are falling, revenue is falling, no dividends, Mike, they're all falling. Well, people sometimes think that companies, well, if they can see that, eventually it's just going to fall straight off the edge of the table and it's going to die. But that doesn't often happen because on the way down, the company reacts and it pulls itself back to some sort of steady state. And that's why you typically have two different types of CEOs. You typically have the CEO that's like the expand CEO, the one that's like, look how good I am. Let's go and buy this thing. Let's expand into China. Let's go and do that. And then once they blow it up, the next CEO comes in and they are the fixer-upper. And they get rid of this business. They sell that bit and everyone's like, yeah, it's a bit of a hard time. And so what I'll say is that like A2 Milk has kind of gone through that bit where it's come down and now it's kind of like, well, let's kind of clean things up. Let's look at the US market. Let's try and revitalize the brand and let's work with regulators around the world. And so we're kind of through that bit there. So, or at least we're emerging from that. So if we come back and I bring it back to reality and I look at news and announcements and let's just have a quick look at the presentation. El Prezzo. So there are a few things that I look for when I'm looking at the company's results. One is the growth in the United States market, because if A2 Milk can continue to expand in the United States market, I truly believe that that's a huge growth driver that's not dependent on those Chinese organizations that I mentioned earlier on. And so there is one thing here that I saw a good friend of mine, Lachlan Berg-Jensen, pointed out on Twitter. He said that if you look at this, the Chinese market is challenging, is what they say, right? But if you look at it, it's basically implying that since 2018, the number of newborns, so the number of children who might be using A2 Milk's infant formula, have gone from 15 million to 9.6. So in just, 4 years, the number of children being born that you need this infant formula has fallen drastically. So the market has shrinked. Now that's not bad, because I mean, if you could sell to even just a small percentage of the 9.6 million babies and infants that are born, well, I mean, you're going to be doing pretty well if you're A2 Milk. But the point is that it's important to understand how the industry is growing. And I think what we've seen is kind of a reversal in that narrative of this is a really strong growth industry, blah, 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 to, well, hold on a second, maybe, there's a bit more to this. We can see here, again, they've highlighted, Chinese business. We can see good share of the channel, I guess, is the main thing. I guess the thing to remember here is that I'm quite biased, and I should mention that I owned shares in a competitor to A2 Milk, and I kind of got burnt by that position. And since then, I've kind of been really put off anything to do with the infant formula, in particular the infant formula in China, for this reason. So I mean, unfortunately, we don't really have a lot of time. So Timothy Pimo, maybe if you come to the ASA event in Sydney, we can talk about it and you can tell me what you think. But we can see here, any type of revenue growth when a business has been sold down so heavily is fantastic, because it shows you that the business is still relevant. It's not a business that is built on fluff. It's an actual business. Cash, 707 million. That is, yeah. We can see here strong balance sheet with closing net cash of 707 million, on market share buyback of up to 150 million, basic earnings per share of 24 cents, up 24% to 10 cents. Robbie said, I am shorting all these companies, by the way. Who cares about 5 years? Who keeps a share for 5 years? Well, hopefully a lot of long-term investors do. I mean, I certainly do. And I hopefully can hold some of them a lot longer than that. But I mean, maybe I'm quite unique in that approach. But I wouldn't be, just in the topic of shorting, I'm not prepared to do that for, I guess I wouldn't be prepared to hold, I wouldn't be prepared to short really any business that is a high quality business. In fact, I don't do any shorting at all. I've never have. So, yeah, that's all I can really say about that, unfortunately. But anyway, okay, so A2 Milk, broadly, it's been really beaten up the last 5 years, but it looks like it could be coming back in a way that's kind of positive, and that's good for long-term shareholders. It's got cash in the bank, which is brilliant. They're doing on-market share buyback, which is positive because it means that they think that the business is capable and undervalued, so that's good. Gray, you've said 14 years is my current in the stock. 14 years is my current longest holding. Wow, Gray, that's incredible. What is that? Pete, you said, I wish I kept my CBA shares from their float. Dividends are more than the shares cost. Yeah, it's incredible when you think about that. The dividends CBA is paying today are more than what the shares floated for at the IPO, which is incredible. Held some for 30 years, Linda. Linda, what shares are those that you've held for 30 years? If you dare disclose them, that would be fantastic. Anyway, guys, unfortunately, we don't have enough time because I ran over time already for A2 Milk. But I'm happy to go into a bit more detail. Just some of the things I look at, obviously, any information around China, the US market, and making sure that the business overall is capable of maintaining profitability as it restructures its business. I misspelled Traybit3P when I created the profile. My nickname at school was 3 pence, but that makes sense. 3 pence was the smallest coin pre-decimal currency, and in slang was a trebit. Okay, there you go. That's where the name comes from. I love it. I love it. Okay, so I'm surprised not all of you asked me about some of the small cap companies that were on my radar. I'll give you some names that you can put on your watch list, perhaps. A company called Kip McGrath came out I think it was yesterday, and I was up really late last night reading through these results. Like normally when I get home at 12 o'clock at night, I'm thinking I just want to go to bed, but I always read these really interesting companies, and that was a really interesting result. Probably not as strong as I was expecting, but still pretty good. Oh, Linda, you got this Westpac share, the share purchase, not share purchase, but the Westpac employee share scheme. So that's how you managed to hold them for 30 years. Incredible, Linda. Well done. Incredible. But yeah, Kit McGrath, which trades under the ticker symbol KME, Mike, just to answer your question. Now, I'm not saying like these are really higher risk businesses, but they're just really interesting because this is an education business. We can see it's fallen quite heavily today because of the result. Investors were expecting more. So I think that's fair to say. Another business that rose yesterday, a business that is very niche and again quite small. I don't own shares in either of these businesses right now, just so you know. But this is a business which XRF Scientific, it sounds very complicated. And to be honest, it probably is for most people. So it's not for everyone. But this business, it does a few different things. But X-ray fluoroscopy, which is what this name stands for. X-ray fluoroscopy is a type of process where you inspect materials for their kind of like, I guess, quality. So you would look at, say, like a sample of metal or a sample of something that you pull out of the ground, like a geologist might pull out, and you can use lasers and you can beam into it and it refracts, and then it gives you a sense of the quality of the minerals inside of that substance. Well, now that we've got through that extremely complicated description of this scientific meaning, XRF, what it does is it creates some of the machines that do that in laboratories to test the quality of materials, but then it also sells the things that go along with that, like the chemicals, or it also sells some of like the ceramic ware or like the metalware that goes into the machines. And if you have to crush up your samples, so if you have like a big rock that needs to be tested for its quality, it would crush up that in a machine, and then that would go into the other machine, which then tests it. And so they do all this kind of testing for mining clients. And you can see here, it's not just mining clients, there's heaps of different clients, but it's mainly mining clients. And we can see here, revenue for this small company has absolutely exploded. But a big reason, just to be as a firm warning, a big reason I believe is because commodity prices over the last 2 years have been really strong, and a lot of miners are reinvesting, and they're saying, well, we need to do more testing. Is this a good mine site? Is this a good mine site? Should we expand here? Is this a good mine site? And we can see that, as well as commodity prices going up, have benefited a company like XRF. Very small company like Kit McGrath, very small and very illiquid, both run by long-term focused management teams, especially Kit McGrath. The father, the company is named after Kit McGrath, who started it in the 1970s, and his son, Storm McGrath, is currently in charge. Okay, so I've got one final thing that I want to leave with you guys, and it's this kind of like, you know, my kind of chance for reflection every week. So intelligence is not a reliable advantage in a world that's become as connected as ours has, but flexibility is. And what this is a quote from Morgan Housel, which is where the podcast comes from before. The quote is, I guess, just an insight into Morgan's kind of reasoning that in this day and age, computers can do most of the calculations. So what advantage do we have as people? It's probably the softer skills, the emotional intelligence that comes with not just investing, but life itself. And Morgan has this tremendous blog. He used to write for the Motley Fool, which is my old haunt. But he has this tremendous blog that he writes, and it's just semi-regularly. And he talks about the questions I have. I have a few questions. And one of those ones is, what is the thing that we are ignoring today that will seem shockingly obvious in a year? So what is something in your life, or something that we take for granted, maybe something that we are ignoring that will seem shockingly obvious in a year? Now, I think some of the things that from an investment perspective, if we take a decade and we think about investments over a decade, some of the things that maybe seem obvious now but weren't obvious at the time were things like software companies being really valuable. Like software companies have always been really valuable, but now they're extra valuable because companies are kind of disclosing that. And I guess there are other things, there are other instances, like if we look at commodity prices, like we look at like coal mining companies, right? And we say to ourselves, well, that was really obvious. That was really obvious. Like coal prices were always going to go up and these companies were always going to be valuable. So what is it in and around you right now? So RBTK, what is it around you right now that you think could be obvious in the future? And that's basically what we're doing as investors. Ben, you said Morgan's book, The Psychology of Money, is a great book. Absolutely. One of the 5 best finance books probably ever written now, Ben. I actually had the luxury of interviewing Morgan, Ben, on our podcast, the Australian Finance Podcast, when the book first came out. You can look that up. RBTK, you said, can you talk about not buying until it is at the right price? You spoke about it last session. Yeah, so I can just quickly talk about this. RBTK. So when you want to basically talk about, are you referring specifically RBTK to Kip McGrath, or are you talking about any business? Mental health, you said, Martin. Mental health is something that will be shockingly obvious. Yes, most likely. I agree with that. So RBTK, are you talking about not buying? And so are you talking about Kip McGrath specifically, or are you talking about anything? What else are you talking about? But if you're talking generally about not buying until it's at the right price, well, I would highly encourage you guys, if you are really interested in, there's many things you can look for valuation, but Brian Feroldi, who's a fantastic investor from the US, what was it called? I would encourage you to go check out this podcast. This is not the one this is the podcast I did with Brian Feroldi. It's in the chat. In general, yeah, okay, so I can answer this. So RBT Cat, I guess, mating for a business that is at the right price. So I'm of this belief, like having having taught value investing for quite a long time, I can tell you that what I've kind of learned over a long period of time is it's not about precision, it's about being generally correct. And so what I mean by that is, even with my business, for example, I have all the financials. I could log into Xero right now and look at all of the numbers, right? But I can't tell you exactly what the company is worth to a decimal place. I probably can't even get to within 5% of that, right? And so for me, that's me with all of the information trying to say what I think my company is worth, right? Rask. Now, imagine I'm trying to do that for a public company where there might be 10,000 employees and I don't have all the information. And yet we seem to think that we can value a company down to like this 1 or 2%, like decimal place. We think that we can do that. But the reality is it's impossible. We simply cannot do that, because even if you run the business and even if you have all the information, something could just come out of left field and just wipe all that away. There could be an industry change. There could be, in the case of what Mike just brought up, or was it Mike? Fleur, sorry, you've said like Microsoft's new AI that I have no understanding of. That's something that you think in the future could be more relevant. It's so obvious today, and we'll say in the future, how did I not see this coming? Well, it's something like that, right? If you think about Google's business, and Google's business is built on search. And, we would have said a year ago, nothing can stop Google. It's so powerful. Well, here's ChatGPT integrated with Microsoft Edge. And all of a sudden you've got a browser that will not let you search. It will just tell you the answer. So why would you even bother searching? So, or a major macro event, says Pete. And so this is the key point here, is that we're not looking to be specifically correct. We're looking to be generally right. And the way you do that, I think, is you avoid the extremes. So you do all of the due diligence that you can, and then you try to pay a price that you believe is fair. Don't worry about what anyone else thinks. What do you believe it's worth? And if you can make that decision in an informed and hopefully with as little bias, cognitive bias as you can, I think that's the best you can get. And then anything beyond that, like trying to be too specific, I think the quote there, RBT Cat, is this. And this came to me from Stephen Arnold from Aorus. He runs the Aorus Global Fund, which is about to list on the ASX. And he said, running a discounted cash flow valuation is like using the Hubble telescope. Move something by 1 mil and you're looking in a different galaxy. And that's the truth. When you do a valuation, if you're trying to be super precise, if you change one thing and you're looking way off in that direction. And so for me, I think for me, it's trying to just kind of make sure I'm not paying a ridiculous price and finding the highest quality business I can. And I think that's where a lot of people go to. So where did I go to learn value investing, Francis? Well, there was nothing, to be honest, when I was learning about value investing, I just looked at the books, like Warren Buffett books. I spoke to everyone in the country that would listen to me. I did university degrees. I did a few of those. And like I started the CFA program, did all that stuff. And then what I realized is that very few people actually know what's going on. And even fewer people are willing to educate you on that. And so that's why I created the business. So yeah, that's why I created the business, Francis. And that's why I teach value investing now. Products with fungi, says Megan. Okay, I'll leave you guys here. You've heard me rant on for enough time. Products with fungi. That's actually funny that you say that, Megan, because you say that that's something that will be blindingly obvious in the future. There is that new series on Binge where the fungus turns contagious and infects everyone and it takes over the world. If you know what I'm talking about, you know what I'm talking about. It's like a post-apocalyptic zombie type show. Kind of like The Walking Dead, except these zombies are actually scary. So that's my piece. It's not a family recommendation. It's for someone that likes post-apocalyptic movies. Thank you, everyone, for tonight. We've got one more week of reporting season, and then we're good to go. It's going to be another big week because the final week is always hectic. So I'll probably be even more tired next week and need another coffee. But thank you, everyone, for tuning in tonight. And don't forget, you can find me online at Owen Rask if you need to send me a message. By the way, ChatGPT is in a response allegedly said I can do what I want. Great way to finish the show.